Hello everybody, Jackson here from the Wolf Squad. Today talking about how to spot a value trap. So value traps are simply companies that look appealing from the outside, but truly the companies are bad investments. So of course a great example is AT&T right now. You can see AT&T is at a 52-week low. Let's check the all-time chart here. You can see it's the lowest it's been since 2010. Okay, so we're in a bull market, a giant bull market. You can see the SP 500 nearly hitting all-time highs, and AT&T is at an 11-year low. So what does this tell you? That tells you that AT&T is suffering financially, right? There has to be a problem for this company to move this badly. Of course, AT&T isn't a volatile stock, but simply falling 25% in less than half a year, that's a bad sign, right? And you can see it's undervalued based on the RSI or oversold, but we could dive into if it's a good investment now, right, or later. But right now we're talking about the value trap. So let's talk more about AT&T and why it wasn't a good investment, right? We have to look back at what the company actually did. So let's get out of here. Let's look at Finviz. This is finviz.com. And basically, one of the most important things about spotting a value trap is simply lots and lots of debt. And you can see right here, debt to equity over 1, where it's 1.11. Any company over 1 or near it simply is over leveraged, has too much debt, and that's a problem, right? You don't want to have an over leveraged company. You want to have a moderately leveraged, if at all, that amount of debt, right? You don't have too much. AT&T in this case has too much. You can see right down here, too much debt. But some other things that pertain to different types of value traps is simply unprofitable or losing money. And of course, AT&T is profitable, not this year though, but in the coming years. So let's expand on that. Yahoo Finance. So we just saw that AT&T does not have a PE ratio, which means that the company did not make money this year. So a good resource to look at for Yahoo Finance is financials. And we're going to see this handy dandy chart right here, where we can see the annual income and revenue, 2017, 2018, 2019, and 2020. You can see profit has fallen from 30 billion to 20 billion to 13 billion to now negative 5 billion. That is not a good sign, right? They are losing money. So in this case, I was wrong talking about it before. AT&T is unprofitable in the year 2020. Now, will they continue? Probably not, right? They're worth $182 billion. They've been around for a long time, longer than this chart goes back. So they're not going to go away. However, they could keep going down because the profit of the last 4 years is only going one direction, and that is down and negative. So AT&T in this case is unprofitable, right? They lost a lot of money Q4, and that took everything down with it, right? So borderline unprofitable. They're usually profitable. They usually make a bunch of money. However, this year they did not. In the last couple of years, they've been losing profit every year. So that's not a good sign. Number one, not a good sign. Of course, number two, we checked out the debt, too much debt. So that crosses off losing money and the debt. And then 3, bad management, right? So what you have to do for this is look up the AT&T, basically, so kind of glitched out here, AT&T CEO or board of directors. And what you want to do is look at their history. because let's say they worked at Enron, that's not a good sign, right? Because Enron failed. Or any of the banks in 2008, that's not a good sign. They failed, right? So I guess leadership would be better. So what you want to do is look through the company, look through the top couple people, and see, of course, where have they worked at before? What has happened with the companies that they worked at before? Um, that's definitely a good resource. If a lot of the companies have failed in the past, it is simply not a good company to invest in because the management is weak. Now, if the management is basically founders running with the company, or the original owner of the company or CEO, or came from startups or something like Uber or Google, then you're probably that's probably a good scenario to be in. You just have to look at these people, right? You just have to look at their history. And the last thing that you want to look for is fraud. Now, fraud is kind of hard to find yourself. What you have to do is just listen to the media. If there's any rumors of fraud, the best thing to do is get out, because most of the time fraud occurs. Now, if any of you have been investing for around a year, then you may know of Luckin Coffee. So this was a company last year that essentially was delisted, and for what reason? It was fraud. They made up different sales and that type of revenue numbers, and they were growing their earnings every quarter. And finally, the SEC found fraud within the company. It went from 40 to like $2 or $5 in a couple weeks, and was delisted from most major platforms. Now it is trading on the over-the-counter market. That's not a good sign. If you hear anything of fraud, you want to get out, right? But AT&T, giant company, haven't heard anything of fraud, so I think they're good there. However, the other things that they hit was unprofitable or losing money. They did do that in the past 4 years. They have been doing that. Bad management, well, I haven't really looked into them yet. But of course, the lots of debt also hit, right? So 2 out of the 4 that we know of. Basically, if any of these boxes are checked, lots of debt, unprofitable, bad management, or hints of fraud, it should be cut out as a future investment. In this case, even though AT&T does look like a good deal here with a under 30 RSI, actually another thing that I didn't even talk about, a high dividend. So sometimes dividends are too high to make sense. In this case, it could be just that. But anyways, if their payout ratio is over like 75-80%, that means 80 or 75 to 80% of their earnings are going to their dividend and not being reinvested in the company. That's a bad sign. And of course, with this merger coming, that's why this news came along. Their dividend is being cut, and so that is soon to be going into action. I'm sure that's an anticipated move with AT&T. So who knows, if you want to have a half dividend here and basically wait a while for your money to make sense, or your investment to make sense, and go right ahead. But I will be dodging AT&T even at these prices due to lots of debt, losing money, and even worse, they're cutting the dividend. Come on. That's my 2 cents, right? And that's basically how you spot a value trap. I'll go over it again. Unprofitable or losing money, bad management, any hint of fraud, and of course the lots of debt over 1 debt to equity ratio. And you can see here over 1. Anywhere near 1 is essentially bad. But yeah, that's it for the video, guys. Kind of a rough visualization of what a value trap looks like, and AT&T is our example today. So I hope you enjoyed. I hope you learned something. If you did, please subscribe to the channel and like this video. We come out with videos every Monday, Wednesday, Friday. So yeah, I'll see you at the next video. Thanks.